You've got $3 million in Apple stock that you bought years ago for next to nothing. Or maybe it's a rental property you paid $300,000 decades ago that's now worth over $3 million. Either way, it feels like your golden ticket to retirement until you try to use it. Because the moment you sell, you hit a trap. Diversify and you are writing a check to the IRS for about $1 million. 1/3 of your wealth gone before you even reinvest a dime. But hidden inside section 664 of the tax code is a tool that lets you sell those assets without paying capital gains tax and still generate roughly 50% more lifetime income than selling outright. The catch? Part of what's left eventually goes to charity. The tool is called a Charitable Remainder Trust, or CRT. Today I'll show you exactly how it works, who it fits best, and whether the trade-off makes sense for your situation. Here's the strategy in plain English. You set up a special trust called a Charitable Remainder Trust. You transfer your appreciated asset, whether it's stock, real estate, or even a business interest, into the trust. The trust then sells the asset. And here's the key. Because the trust is tax exempt, it pays zero capital gains tax on that sale. Let that sink in. Instead of losing 1/3 of your wealth to taxes immediately, the full $3 million stays in the trust, ready to be reinvested. Now, the trust pays you an income stream every year. You choose the payout rate, typically between 5% and 8%. That income can last for your lifetime, your spouse's lifetime, or a fixed term up to 20 years. You can also structure it so your children receive payments, either as successor beneficiaries after you're gone or as co-beneficiaries in a term of years trust. So with $3 million fully invested inside the trust at a 5% payout, you're getting $150,000 a year for life. Compare that to selling outright. After the $1 million tax bill, you have $2 million left to invest. At 5%, that's $100,000 a year. Same investment strategy, same return assumptions, but you are getting 50% more income with the CRT. That's the power of keeping the IRS out of your pocket up front. Think of it like farming. If you sell outright, the IRS takes 1/3 of your seed corn before you plant. With the CRT, you plant the whole harvest and live off the crop every year. Now you are probably thinking, what's the catch? And there is one. At the end of the trust term, whatever remains must go to charity. That part is non-negotiable. It's the price you pay for avoiding the capital gains tax up front. The IRS uses what's called the 10% remainder test, meaning that when you set up the trust, at least 10% of the initial value must be projected to go to charity at the end. That's the minimum toll required for selling the assets tax-free inside the trust. But here's what surprises most people. You don't need to be especially charitable to use a CRT. Many high net worth families who consider this strategy aren't writing big checks to nonprofits or sitting on foundation boards. That's just not part of their financial picture. And that's okay, because they are not doing this to be philanthropic today. They are doing it to maximize their lifestyle, protect their wealth, and avoid handing a massive chunk to the IRS tomorrow. Think of the charitable remainder like a toll you pay to drive on a private express lane. You are not paying because you love the highway. You are paying because the alternative is sitting in traffic for hours and losing time you'll never get back. A CRT works the same way. That future charitable remainder is the tool that gives you access to a structure that can legally eliminate $1 million capital gains tax today and keep your full principal working for you instead of the IRS. And when you compare the outcomes, this is how families think about it. If you sell outright and pay $1 million in taxes, that money is gone forever. You get nothing. Your kids get nothing. The government gets all of it. With a CRT, you avoid that $1 million tax hit. You generate roughly 50% more income for life. And yes, the remainder eventually goes to charity. But at least it goes to an organization you choose, supporting a cause you care about, after you've enjoyed decades of higher income first. So here's the real question. Would you rather give 30% to the IRS today or give 10 to 20% to a charity you select decades from now after maximizing your income throughout retirement? For a lot of people, that math is very clear. Alright, so that's how it works and what you are trading off. Now the big question, is this right for you? Let me show you exactly when this makes perfect sense and when it absolutely doesn't. CRTs are designed for 3 types of situations. First, concentrated stock positions. Maybe you worked at a tech company and earned stock over the years. Or you bought shares of Apple, Nvidia, or Amazon back when they were cheap. Now that one stock represents 60, 70, maybe 80% of your net worth. Every time the stock moves, your stomach lurches because your entire retirement is riding on one company. You are trapped in what I call the prison of concentration. A roller coaster you can't get off without paying $1 million exit fee. fee. You know you should diversify, but the tax bill is paralyzing. This is exactly what CRTs are designed for. Second, real estate you're tired of managing. You've been a successful real estate investor, but now you are done. You don't want tenants calling at 2 a.m. You don't want to deal with repairs and property management. You want out. But selling triggers massive capital gains. A CRT lets you exit without the upfront tax hit and convert that property into a diversified income stream. Third, business exits. Your business is your largest asset. You are ready to retire, but selling means writing one of the biggest checks of your life to the IRS. If you are comfortable with the charity component, a CRT can let you exit the business, defer the tax, and create lifetime income from the proceeds. The common thread: you have a large, concentrated, appreciated asset. You want to diversify, and you are at least neutral about some portion eventually going to charity. Now, this doesn't work for everyone. Let me tell you who this isn't for. If you are absolutely opposed to any wealth going to charity, even decades from now, a CRT isn't for you. That's just the reality. The IRS requires it, and there is no way around. But remember, doing nothing means gambling your entire legacy on a single bet. One stock, one property, one business. That's actually the riskiest choice of all. Also, if your asset isn't large enough, the costs don't make sense. Setting up and administering a CRT involves legal fees, trustee fees, and ongoing filings. For anything under $500,000, the juice often isn't worth the squeeze. You need enough in the trust to make the savings meaningful. And third, if you want your kids to inherit every dollar, CRTs don't align. Yes, you can use life insurance strategies to replace wealth going to charity, but that adds complexity and cost. Some people do it, but it's not simple. Here's what commonly happens. Someone hears about CRTs, gets excited about the tax savings, then realizes they are not comfortable with the charity requirement. And that's okay, you don't have to force it. If CRTs don't fit, you are not stuck. There are other tools in the toolbox. Let me give you a quick rundown. If you want to defer taxes but can't stomach the charity component, here are your main alternatives. Installment sales. Instead of selling all at once, you spread payments over several years. The tax is spread out too, so you're not hit with a $1 million bill in year one. The downside? You still pay the full tax eventually, and you are taking on credit risk if the buyer doesn't pay. Exchange funds. If your problem is a concentrated stock position, you can contribute your shares to a pool with other investors in the same boat. You get back shares of a diversified fund without triggering tax. The trade-off is liquidity. You are usually locked up for 7 years, sometimes longer. Prepaid variable forward contracts. This is a Wall Street tool. You agree to deliver your stock at a future date in exchange for cash today. You get liquidity now, defer the tax until the contract settles, and you maintain some upside if the stock goes up. These are complex, expensive to set up, and the tax treatment isn't always predictable. They work for some situations, but they are not simple. Qualified Opportunity Zone funds. If you have capital gains from any source, you can roll them into an Opportunity Zone fund and defer the tax. Hold it long enough, and the appreciation on the Opportunity Zone investment is tax-free. But you are investing in specific real estate or business projects in designated areas. It's not a pure diversification play. And finally, donor-advised funds. If you want to make charitable contributions using appreciated stock, donor-advised funds let you get the tax deduction now, avoid capital gains, and recommend grants to charities over time. But this is for assets you are giving away, not assets you need for income. Each of these tools has a place. The question is which one fits your situation. And honestly, that's where a good advisor adds value, helping you weigh the trade-offs and choose what actually aligns with your goals. So how do you decide? Let me give you a framework I use with every client who's considering a CRT. Here are 5 questions to ask yourself. First, do you have a concentrated position that's creating real financial risk? If more than 50% of your net worth is in one stock, one property, or one business, you have concentration risk. If that asset drops 30%, your retirement is in trouble. That's the starting point. Second, is the capital gains tax large enough to matter? If you're looking at a $50,000 tax bill, maybe you just pay it and move on. But if you are staring down at $500,000, $1 million, $2 million in taxes, now we are talking about life-changing amounts. That's when sophisticated strategies make sense. Third, are you at least neutral about charitable giving? You don't have to be passionate about it. You don't need to have a cause picked out today. But if the idea of some portion going to charity eventually doesn't bother you, CRTs become viable. Fourth, Do you value income over leaving every last dollar to heirs? CRTs maximize your lifetime income. If your priority is financial security and lifestyle now, and you are less focused on leaving the maximum estate, CRTs fit. If your goal is to maximize every dollar to your kids, maybe they don't. And fifth, are you willing to set this up properly with professional help? CRTs require legal documents, trustee management, tax filings, and investment oversight. This isn't a DIY project. You need an estate attorney to draft it, a CPA to handle tax reporting, and a financial advisor to manage the investments and coordinate everything. If you answer yes to those 5 questions, a CRT is worth exploring seriously. Alright, let me wrap this up with key points. The hard truth about CRTs is that the remainder must go to charity. That's the bargain with the IRS for selling assets without paying capital gains tax upfront. But if your goals are to break free from the prison of concentration, diversify safely, and keep more of your wealth working for you instead of the government, a CRT can be the tool that buys you that freedom. It lets you turn a potential $1 million tax bill into a lifetime income stream that's 50% higher than selling outright. And it gives you confidence that your financial future isn't riding on one stock, one property, or one business. The question is whether they fit your situation. If you have a large concentrated position, a significant tax bill looming, and you are at least comfortable with the charitable component, this is worth a serious conversation with your advisor. If you are holding a concentrated position and you are torn between the risk of staying invested and the tax hit of selling, you are not alone. It's one of the toughest decisions financially successful families face, and it's rarely as simple as just diversify. If you'd like to talk through your situation and see whether working together makes sense, use the link below to schedule a short introductory call. We'll get a clear picture of your goals, your concerns, and what you are trying to solve. And if it's a good fit, we can discuss next steps for building a full strategy. And whether we end up working together or not, there is something else you should look at next: your existing estate documents. A lot of families still have old bypass trusts written before the 2017 tax law changes, and those outdated documents can quietly wipe out huge tax benefits and cost your heirs 6 figures. Even if you set up a CRT or another strategy perfectly, your old trust language can completely undermine it. In this video, I'll show you exactly what to look for and how to fix it before it costs your family. Make sure to check that out next. Thanks for watching.